If these numbers are wrong, a merger of $12 billion, it could collapse even before the market opens. It's 3:12 a.m. in Manhattan. The entire office is empty, except for a row of screens that are still lit. Spreadsheets open, charts flashing, endless lines of numbers representing entire companies, jobs, investments, and billions in capital. The city outside is asleep, but not Wall Street. In front of you is a financial model that needs to be delivered in less than 2 hours. And there's one detail that makes everything even stranger. You've only been on Wall Street for 3 days. But this story didn't begin tonight. It started a few months ago, when you decided to enter one of the most ruthless systems in the global economy. The system of Wall Street. Level 1. The invisible intern. You join the investment bank as an intern. His name tag still looks out of place there. The building is immense, silent, and at the same time charged with an energy that's hard to explain. The lobby is made of cold marble, illuminated by white lights that reflect off the glass walls. People in suits pass quickly by without looking directly at you. Each one seems to have an urgent destination, an important meeting, a number that needs to be defended. When you step into the elevator for the first time, you notice something curious. Nobody talks. Everyone is looking at their cell phone screens, reviewing emails, charts, or presentations. The silence isn't uncomfortable. It's simply part of the system. When the doors open onto the investment banking floor, you immediately understand that this place operates at a different pace. Tables arranged in long rows, multiple screens at each workstation, market charts flashing red and green, spreadsheets open on virtually all monitors. That's where the work happens. On the first day, you notice something that nobody officially mentions. Nobody's leaving. When the clock strikes 6 in the evening, people don't get up to go home. They just order more coffee. Some analysts take off their jackets, loosen their ties, and continue working as if the night were simply a natural extension of the day. Analysts continue working while the rest of the city returns home. Lights remain on into the early hours of the morning. Stacks of presentations are scattered across the tables. Each one represents a company, a negotiation, a potential billion-dollar deal. Empty coffee cups pile up next to the keyboards. You begin to understand that there is an unspoken rule in that environment. No one explains it directly, but everyone follows her. If you can't keep up the pace, the system simply replaces you. At this level, your responsibilities seem small. You don't negotiate with CEOs. You don't decide on mergers. You don't show up for important meetings. Their work is much more invisible. Update spreadsheets, check numbers, adjusting charts in presentations that executives will show to clients. You review revenue data, operating costs, projected growth. Small changes in one cell can completely alter the final result of an analysis. At first glance, it looks like just technical work. But then you realize something important. Even small tasks carry risk. One number out of place can distort an entire assessment. A poorly calculated projection can influence an investor's perception. An incorrect formula can affect a negotiation involving billions of dollars. And in this environment, mistakes rarely go unnoticed. You start to observe how more experienced analysts work. They type fast. They revise the numbers several times. They compared old spreadsheets with new projections. They seem to live inside spreadsheets. And gradually you learn 3 principles that nobody writes down anywhere. Wall Street values speed. Decisions need to happen quickly. The market doesn't wait. Wall Street values precision. Even small inconsistencies can destroy credibility. And Wall Street has no patience for mistakes, because every mistake carries real consequences. At this stage, you are still invisible to most people. Executives walk past the hallway without noticing his presence. Important meetings take place in closed rooms. But you start to gain something very valuable. Access. You begin to see how billion-dollar decisions are truly made. Entire teams spend weeks analyzing companies. How presentations are prepared to convince investors. How each graph, each table, and each number is part of a larger narrative. You realize that behind every merger announced in the media, there's a silent process that begins at desks like yours. But while you gain access, you also begin to lose something. Hours of sound. Some nights you leave the office when the city is almost empty. Normal routine, days are starting to blend together. Mondays feel like Fridays. Early mornings feel like afternoons. Any notion of balance. Friends are starting to notice that you're almost never available. But within that system, these losses are considered part of the process. Because to move up in the system, you only need to prove one thing. That can keep up with the pace. It's not just a matter of intelligence, it's not just a matter of technical skill, it's a matter of resistance. Those who stay long enough begin to rise. Those who can't handle it disappear silently. And at that moment you begin to realize something fundamental about Wall Street. It's not just a place where money circulates. It is a system that constantly tests those who are inside it. And as an intern, you have just entered the first level of this test. Level 2. Real learning. Several weeks pass. The pace that initially seemed impossible begins to feel familiar. You no longer look at the clock waiting for the end of the workday, because you understand that in that place, the workday practically doesn't exist. Time works differently on Wall Street. Now you understand better how the system works. You no longer just observe from afar. Now participate. The analysts who previously barely noticed your presence are starting to include you in small parts of the work. Not because they still fully trust you, but because the volume of tasks in that environment is simply too large for a single person. Your responsibilities increase. You spend less time organizing files and more time immersed in gigantic spreadsheets that seem endless. You start working directly on complex financial models. Spreadsheets created to try and predict the future of entire companies. These models attempt to answer questions that involve billions of dollars. How much is this company really worth? Will it grow in the next 5 years? Can she pay her debts? Or is it closer to collapse than the market imagines? To answer these questions, the models need to consider dozens of variables. Projected recipes, expected growth under different scenarios, hidden debts that only become apparent when you carefully analyze the reports, cash flows that show how much money actually enters and leaves the company. Each number needs to make sense within a larger structure. And then you realize something that completely changes the way you look at work. Each cell represents millions of dollars. A small change in a growth projection can drastically increase or decrease the estimated value of a company. A change in the interest rate can alter the cost of financing. A wrong assumption about the market can distort the entire analysis. And it is at this moment that you learn something fundamental about Wall Street. She doesn't just negotiate with companies, she negotiates expectations. The market doesn't just react to what a company is today. He reacts to what people believe she will be like tomorrow. If the numbers suggest growth, investors are getting involved. Funds buy stocks. Analysts recommend investments. The company's value increases. But if the numbers suggest risk, the effect can be immediate. Investors are pulling back. Trust is waning, and billions of dollars can disappear from market value in just a few hours. At this level, you gain something new within the system. Trust. But it's a limited level of confidence. Your superiors are starting to trust you with more sensitive tasks. They ask you to review important parts of a model. Sometimes you are asked to update projections before a meeting. Other times you receive spreadsheets that need to be corrected quickly before they are sent to executives or clients. This confidence is a sign of progress. It means you've stopped being just an observer, but it also brings something you didn't feel before. Exhibition. Now, if something is wrong, the error will have its name associated with it. If a number is out of place, if a formula is broken, if a projection is poorly calculated, someone will ask who prepared that model. And in this environment, reputation is built slowly, but can be destroyed very quickly. You start to see how the most experienced analysts deal with this pressure. They revise the numbers several times. They are comparing different models. They question every assumption before accepting a result. Nothing is considered definitive until all the data makes sense. And then you realize something important. At this level, intelligence alone is not enough. Many people who make it to Wall Street are extremely intelligent, graduates from top universities, experts in mathematics, economics, and finance. But not all remain, because in addition to intelligence, the system requires two very specific things. Extreme resistance, the ability to continue working even when fatigue begins to build up, and absolute precision, the discipline of reviewing every detail before trusting the result. Because the further you advance within the system, the greater the impact of each decision, the greater the impact becomes. And the greater the impact, the smaller the margin for error, the smaller the margin. At this point, you begin to understand that you are only at the beginning of the journey. The real test is yet to come. And on Wall Street, the test always comes when you least expect it. Level 3. The first real pressure. And then comes the night that changes everything. Up until that moment, your presence within the bank still felt like part of a learning process. You reviewed numbers, adjusted spreadsheets, observed how more experienced analysts built complex models. Everything seemed intense, but there was still an invisible sense of protection. As an intern, you weren't, yet fully responsible for anything that could move the market. But Wall Street has a peculiar way of testing who enters the system. She doesn't announce when the test starts. 3 days after officially joining the team, your boss shows up at your desk, without warning. He doesn't ask questions, doesn't explain the context, doesn't offer much time for conversation. He just puts a gigantic file on your screen and points to the monitor. The file is large, too big to be just another routine spreadsheet. When you open the document, you immediately understand what is in front of you. A complex financial model linked to a potential merger between two companies valued at billions of dollars. One of these companies is an industrial conglomerate with operations in several countries. The other is a technology company that has grown rapidly in recent years and has now become a strategic acquisition target. If the deal is approved, it will be one of the largest mergers in that sector in recent years. Your boss only says one sentence. This model needs to be ready before the market opens. Nothing more. No further explanation needed. No room for negotiation. You glance quickly at your watch. The market opens in just a few hours. When you start navigating through the spreadsheets, you realize the size of the challenge. Hundreds of lines of data. Market valuations based on multiples of comparable companies. Growth projections that attempt to estimate the performance of companies over the next 5 or 10 years. Discounted cash flows attempt to calculate the true value of a company today based on future revenues. And hidden among the data, some more complex layers also appear. Debts that are not immediately visible in the main reports. Financing structures that alter the cost of operation. Growth assumptions that depend on market scenarios that are difficult to predict. You begin to review the formulas, line by line, cell by cell. And then something catches your attention. The numbers don't add up. The final value calculated by the model does not match the intermediate projections. Something within the spreadsheet structure is distorting the result. You begin to investigate more deeply. Some formula is broken. Perhaps there's a misreference between different spreadsheets. Perhaps an accumulated error in a revenue projection. Or perhaps an overly optimistic assumption about the growth of the acquired company. Any of these possibilities could completely alter the evaluation. And at that moment, you understand the gravity of the situation. If this mistake goes unnoticed, the merger could be approved based on incorrect data. Executives may make decisions believing that the company is worth more than it actually is. Investors could commit billions of dollars to a deal built on distorted assumptions, and then the risk ceases to be theoretical. It becomes real. Now you need to decide how to proceed. Redo the entire model. This means reviewing every formula, every assumption, every calculation within the spreadsheet. It can take hours you may not have. Simplify the numbers and move on. Some analysts do this under extreme pressure. They adjust some projections, ignore minor inconsistencies, and deliver the model on time. But there is a problem. If someone discovers the error later, the responsibility may fall on whoever prepared the file. Or take the risk and present the model as is. Perhaps no one will notice the mistake. Perhaps the problem lies in a relatively insignificant part of the analysis. But if the mistake is significant, the impact could be enormous. Every choice has consequences. Reworking the model can be too time-consuming and delay delivery. Simplifying the numbers may only temporarily hide the problem. Presenting the model in this way could put the entire operation at risk, and then you realize something fundamental about Wall Street. Sometimes, huge decisions begin with something seemingly small. A spreadsheet, a formula, a single cell in a financial model. You look at the clock again, time is passing. And while the market outside is still asleep, you need to decide what to do. Because if the numbers are wrong, a multi-billion-dollar merger can collapse before it even begins. Level 4. The choice. You decide to redo the entire model. It's the hardest decision, but it's also the only one that maintains its integrity intact. The clock is ticking. 3 a.m. 4 T's. The office is quiet. The city continues to sleep outside. You review each formula, every assumption, each projection. The hours pass, and then something starts to fall into place. The numbers finally make sense. As the sun begins to rise over Manhattan, the financial model is complete. Final climb. Later that day, your boss shows up again. He analyzes the numbers in silence. Check a few lines. The atmosphere becomes heavy. For a few seconds, you don't know what to expect. Then he says just 2 words. Good job. Nothing more. No exaggerated praise. No celebration. But before leaving the room, he pauses. And it says something you'll never forget. If you manage to survive the first week, maybe I can survive on Wall Street, is left over. But at that moment, you begin to understand something important. In this system, every victory is temporary. Each promotion brings more pressure. Every future decision involves greater risks. Today was just a financial model. Tomorrow could be an operation that moves billions in real capital. And one day, the system itself can turn against you. At that moment, you understand something that few people realize. Wall Street doesn't just reward intelligence. She rewards resistance. Resistance to rhythm, pressure resistance, resistance to the system itself. Because there is a silent truth within this world. Individuals enter, individuals leave, but the structure remains. And for you, that was just the first night inside it.